Topic introduces financial correlation risk, which refers to the possibility that changes in correlations between assets or markets may generate unexpected losses. Correlation is a fundamental concept in risk management because portfolio diversification benefits depend heavily on the relationships among asset returns. When correlations increase during periods of market stress, diversification becomes less effective, causing portfolio risk to rise sharply. The program emphasizes that correlation risk is especially important for institutions holding complex, multi-asset portfolios. Even assets that normally exhibit weak or negative correlations may move together during crises, creating systemic vulnerabilities and amplifying market losses across financial institutions and global markets. The topic explains that value at risk (VAR) and expected shortfall (S) are highly sensitive to changes in asset correlations because correlation directly affects portfolio volatility. A portfolio with low or negative correlations generally experiences lower overall risk due to diversification effects. However, when asset correlations increase unexpectedly, portfolio losses may become significantly larger than anticipated. The program notes that covariance matrices are essential inputs for VAR calculations because they capture the relationships between portfolio assets. Consequently, inaccurate assumptions regarding correlations may lead to severe underestimation of market risk. During financial crises, rising correlations often magnify losses simultaneously across equities, bonds, commodities, and credit-sensitive instruments. Topic discusses correlation swaps, which are derivative instruments designed to allow investors to trade realized correlation against a predetermined fixed correlation level. Correlation swaps are commonly used by hedge funds, banks, and institutional investors to hedge or speculate on changes in market relationships. The payoff depends on the difference between realized correlation over the contract period and the fixed correlation specified at initiation. Because many multi-asset derivatives are sensitive to correlation assumptions, correlation swaps provide an important mechanism for isolating and managing correlation exposure separately from directional market risk. These instruments are especially useful in structured products and volatility trading strategies, where correlation plays a major role in pricing and risk assessment. The topic also examines the role of correlation risk during the global financial crisis of 2007 to 2009. During the crisis, many institutions experienced severe losses because assets previously believed to be diversified suddenly became highly correlated. Structured credit products, such as collateralized debt obligations (CDOs), were particularly vulnerable to rising default correlations. The topic highlights the experiences of major institutions such as American International Group, AIG, and Lehman Brothers, whose excessive leverage and exposure to correlated credit risks contributed to systemic instability. Correlation assumptions embedded within pricing and risk models failed dramatically under stress conditions, revealing how interconnected exposures can amplify losses across the entire financial system. Another important topic is the relationship between correlation risk and credit risk. Default correlation measures the likelihood that multiple borrowers or counterparties default simultaneously. Lower default correlations improve diversification and reduce portfolio credit risk, while higher default correlations increase the probability of large aggregate losses. Creditors therefore benefit from diversifying exposures across industries, sectors, and geographic regions to reduce correlated defaults. The program also explains that default probabilities and default correlations change over time and are particularly sensitive during economic downturns. Rising default correlations were a major contributor to widespread losses in mortgage-backed securities and structured credit products during the financial crisis. Topic extends the discussion by examining how correlation risk influences other forms of financial risk, including market risk, liquidity risk, and systemic risk. During stressed market conditions, correlations among risky assets often converge toward one, causing simultaneous declines across asset classes. This phenomenon weakens diversification precisely when it is needed most. The topic emphasizes that systemic crises intensify correlation risk because institutions react similarly to adverse information, margin calls, liquidity shortages, and investor panic. As correlations rise, financial contagion spreads rapidly through interconnected markets, increasing the probability of widespread instability. Effective risk management, therefore, requires continuous monitoring of evolving correlation structures rather than relying solely on historical averages. The program also discusses correlation trading strategies and exotic derivatives that depend heavily on asset movement. Multi-asset options, basket derivatives, and quanto options are examples of instruments whose values are highly sensitive to correlation assumptions. Quanto options, for instance, allow domestic investors to gain exposure to foreign assets while hedging currency risk, making the payoff structure dependent on correlations between exchange rates and asset returns. Correlation traders attempt to profit from differences between implied correlations embedded in market prices and expected realized correlations. Because these products involve complex interdependencies, small changes in correlations may produce substantial gains or losses, increasing the importance of sophisticated modeling and stress testing procedures. Overall, topics demonstrate that correlation risk is a central component of modern financial risk management. Correlations influence portfolio diversification, derivative pricing, capital allocation, and systemic stability across global financial markets. The global financial crisis revealed that historical correlations may break down abruptly during periods of stress, exposing institutions to concentrated losses despite seemingly diversified positions. Correlation swaps and related derivatives provide tools for managing and trading these exposures, but they also introduce additional complexity and model risk. The program emphasizes that successful risk management requires understanding how correlations evolve dynamically across market conditions.